Hey, my name's James Nicholson. Welcome to my YouTube channel. In this video, I want to talk about whether you should look at getting a fixed mortgage right now or a tracker. You see, historically, most people for ages used to get variable rate mortgages because mortgage rates didn't fluctuate so much. But then fixed rates became more popular after interest rates surged up. And now fixed rates is what most people in the market get, because what they give you is that element of security. You know what your payments are for either 2 years or 5 years. The problem that you get with that is that should rates drop considerably, which they might do in 2026, then you always miss out on that reduced payment. So in this video, I want to talk about what expectations are with the Bank of England. Are we going to see any more mortgage rate cuts, and what option should you go for? What's best for you, a fixed rate or a tracker? Now, with all of this is not financial advice. You should always speak to a mortgage broker. Every mortgage video that I talk about, I recommend getting a broker, because the broker will go through your needs and requirements and get the best rate for you. So before we jump into this, if you're new around here, do make sure you subscribe to the channel over there and hit that bell notification. We've just hit 50,000 subscribers, and by subscribing you'll get all the latest house price news, interest rate news, property investing tips, and much more. And let's get some views on this video. Your part simple. All you need to do is smash like, tick a like, do something to the like button. That really helps with the YouTube algorithm, and that really does help the channel grow. So thanks to everyone that does that. So let's look at the two options. Firstly, let's look at where the Bank of England sits. So currently the Bank of England's rate is at 4%. 4%. Now, that was expected to go down significantly in 2025, and it didn't. Things changed. Inflation was more sticky, and inflation started to rise again. In August, the Bank of England revised their inflation figures, and they said that inflation would hit a peak of 4%. It didn't quite get there. We're stuck at 3.8% now, and hopefully that is our new high, and hopefully we'll start to see inflation coming back down. If the inflation comes back down, then the Bank of England is going to cut interest rates. Another consideration is unemployment. You see, the Bank of England's got two things that they want to happen. One is inflation to be there or thereabouts around 2%. That's important to them. And the second is maximum employment, getting as low unemployment as they possibly can. So inflation's gone up recently, but so has unemployment. And so that's given them the conundrum. What do we focus on now? Is inflation just going to come down naturally and we focus on maximum employment? And that's why in August, even though inflation was rising, they still cut interest rates. But now they're in a wait and see approach. The good news is inflation was lower than expected in September. I was a bit suspicious about that. If you've watched some of the videos, you can go and see why. Any older videos you want to see, click on Property Accelerator below the videos and check out those. But inflation was at 3.8%, and that gives the bank the ability to cut rates. It's more likely that that's going to happen. And the expectations are that in November we'll hold rates, and in December, on December the 18th, we will cut rates. Now, if you're on a variable mortgage or a tracker mortgage, a variable could be because you finished your deal and you're just sitting on the variable rate with a lender. That's expensive. That could be at 9% with a lot of lenders. Or a tracker is where you're following that rate down. And so with a tracker rate at the moment, the best deal at the moment is with, I've forgotten their name, the Cumberland Bank. And they have, so they're called the Cumberland. You can go and check them out. They have a rate of 4.23%. So just under 0.25% above the Bank of England's base rate. So if you work with a lender like that, and then the Bank of England cut rates in December to 3.75%, this would drop to around 3.9%. So you would be below that magic 4%. So that would be good. And if you have the belief that the Bank of England is going to cut interest rates in 2026, and you're able to also weather if interest rates go up. You've got to consider both scenarios here. If interest rates went up, you would have to pay more money each month. If interest rates go down, you would pay less. So it is a bit of a gamble. So you shouldn't do this, get a tracker if you're stretched. If every month the mortgage payment is a real difficult payment for you and you couldn't afford for it to go up, I wouldn't go for a tracker. But if you're comfortable, you've got some extra cash and you like a bit of a gamble, this could be the option, because the Bank of England is likely to cut in December and they're likely to cut multiple times next year as unemployment goes up after a bad budget in November, and businesses are slowing down really as well. So the chances are we'll go into a recession and they would cut rates in that scenario. No one knows how far, but the probability is more likely that we will get interest rate cuts next year than interest rate increases. So that's the benefits of a tracker. So what about a fixed rate? Well, fixed deals, you can get deals around 3.93%, so slightly lower than this. And you can get those for 5 years. That gives you that predictability. So if you have an income that's fixed, you know what you're going to get, you like the certainty and being able to sleep at night knowing you can afford your mortgage for the next 5 years, then this could be the option for you. And that's what a lot of people are going with. In fact, most people now go with fixed mortgages. They're more common than tracker or variable rate mortgages. They are the number one product at the moment. But the downside is, if the Bank of England and we had a heavy recession and they cut rates to 1.5% because unemployment was going up, the recession was deep, then you'd miss out on that. You would miss out on those lower payments. So the difficulty here is deciding what's best for your scenario. It's not what's best for me or what I think you should do. It's what's best for you and your family and your mental health and certainty. Because some people, it really stresses them out, the fact that the interest rate could go up. And we've done content videos recently where lenders have increased their rates. And that's been down to the fact that the unpredictability in the markets, the fact that the government isn't doing particularly well at growing the economy at the moment, the fact that inflation forecasts are rising. That is a difficult scenario. And so rates did go up. Mortgage lenders did increase their rates. But if you're on a tracker, then your real focus is what happens with the Bank of England. You're expecting one more cut this year. I think you get 2 or 3 at least next year. If the economy's bad, you'll get even more. So let me know in the comments below what you would do. Would you fix or would you go on a tracker? Do comment below. Do also grab our ebook on mortgages. Nearly 4,000 people have grabbed this now. This will teach you how to get the best broker. That's important. I said you should use a broker to find out where and when to get a broker, when to start your mortgage process, and also getting the off-market lenders. You see, there's tons of lenders out there that aren't on Money Supermarket, that aren't with your broker. Think of Direct Line for car insurance. There's loads of lenders like that. They're in the ebook. So grab a free copy of that. It's in the description or in the first comment. Do smash like, do subscribe, and check out all the other content as well on this channel, including this video right here.